Welcome, curious minds, to another deep dive. Today we're plunging into a topic that could, well, fundamentally reshape how millions of Americans save for retirement. We're talking about something directly impacting your financial future.
Definitely.
We've got a stack of fascinating sources here, everything from breaking news reports to pretty detailed financial market analyses. And it all revolves around a very significant development coming out of Washington, D.C.
Yeah, it really feels like a moment that challenges, some long-held ideas about stability and risk and maybe even innovation in finance.
For sure.
And what's truly fascinating here, I think, is just the sheer potential scale of this shift. I mean, we're talking about the multi-trillion-dollar U.S. retirement market.
It's enormous.
An immense reservoir of capital, right? And how it might soon open its doors to assets that have, well, traditionally been on the sidelines, often seen as too niche, maybe too volatile, or just too risky for the everyday saver. This isn't just some small tweak. It feels like a monumental moment that could really redefine what a quote-unquote traditional retirement portfolio looks like for, well, maybe generations to come.
That's a powerful way to put it. It really suggests, like you said, dismantling some assumptions. For so long, retirement investing has had this very specific set of rules, a pretty narrow range of options. And this new development just seems to challenge that directly.
So what exactly is our mission today in unpacking all this?
Yeah, what are we digging into?
We're going to dive into the specifics of this executive order, explore the alternative assets it actually targets, especially cryptocurrencies, which is obviously a big one.
Huge.
We need to understand the history here, how we got to this point, then delve into what the major financial players are already doing, because they're not waiting around.
No, they're definitely moving.
Yeah.
And ultimately, connect all the dots on what this means for your retirement savings and, the whole financial landscape. And hey, just a quick note while we're setting the stage, if you find these deep dives valuable, things like subscribing, commenting, giving us a like, it really does help us out.
It really does. Helps with the algorithm, keeps us visible.
Exactly. Let's just keep bringing you these deep dives into the topics that matter. Okay, let's unpack this.
Yeah.
So the details from our sources on this White House announcement, they sound pretty compelling. Can you walk us through what was revealed? Because it sounds like a really immediate, impactful kind of shift.
Yeah, indeed. The sources confirm a major announcement from the White House just recently, Thursday, August 7th, 2025. President Donald Trump is set to sign an executive order today, and the headline is, it will allow what they're calling alternative assets directly into 401k.
Yeah.
And like you said, this isn't just a minor rule change. It feels like a profound reevaluation of what's considered appropriate, maybe suitable, even beneficial for retirement savings, kind of moving beyond just stocks and bonds.
And it's not just a vague alternative asset statement, is it?
Yeah.
I saw the order actually name specific asset classes that haven't really been in these plans before. Which ones are now officially on the table?
That's right. The specificity is really key here. It's not just a suggestion. The core of the announcement is explicitly including several asset classes that, have historically been left out. Specifically, the order names cryptocurrencies,
The big one.
private equity, and real estate. These are the alternative assets now deemed permissible. It's clearly a deliberate move to broaden the investment horizons for these defined contribution plans. Aiming to offer access to things that, sure, might have higher returns, but definitely carry different risk profiles.
Right. Can you quickly break down what those mean for someone maybe not super familiar, private equity, real estate in this context?
Sure. So private equity, broadly speaking, it's investing in companies that aren't publicly traded on stock exchanges. Think things like buyouts, venture capital for startups, growth capital for established private firms, potential for high returns, but usually longer holding periods, less liquidity. You can't just sell it tomorrow.
Gotcha. Locked up longer.
Exactly. Real estate, well, that can range from directly owning properties to investing in funds that hold various types of property. It often brings diversification, maybe a hedge against inflation.
Okay.
And then, of course, cryptocurrencies, digital or virtual currencies secured by cryptography, known for decentralization, but also, let's be honest, significant volatility. And they have their own unique tech risks and rewards.
So it's not just a statement of intent, it's an actual directive. What's the mechanism here? How does this executive order actually make this happen within the, pretty complex regulatory world?
That's a crucial question, right? How does the rubber meet the road? The order lays out a clear, sort of multi-pronged mechanism. First, it directs the U.S. Secretary of Labor to conduct a thorough review of the fiduciary guidance.
Okay, fiduciary guidance, that sounds important.
It's paramount. Fiduciary guidance is basically the legal and ethical duty of plan managers, employers, administrators, advisors to act solely in the best interests of the participants.
Right, protect the favors.
Exactly. Traditionally, that meant prioritizing safety, liquidity, transparency. So this order isn't just saying let them in, it's telling the Department of Labor to reevaluate how those strict duties apply to these, well, less conventional, often more complex assets, like what new rules or due diligence processes are needed to still meet that high standard.
And it specifically mentions plans governed by ERISA, right? The Employee Retirement Income Security Act of 1974. Why call that out specifically?
It's crucial because ERISA is the bedrock. It sets the minimum standards for most private sector retirement plans, and crucially, it governs how fiduciaries must behave. So by referencing ERISA, the order signals that this isn't about ditching the protections.
Okay.
It's more like directing the doll to figure out how these new assets can fit within that existing protective structure. It suggests, the door is opening, but it's not a free-for-all. It's a formal push to re-examine the guidelines towards inclusion, but still under that ERISA umbrella.
And the Labor Department isn't the only agency involved, is it? The order also loops in the SEC, the Securities and Exchange Commission. What's their role supposed to be here?
Precisely. It's a two-pronged approach, Labor and SEC. It signals a pretty comprehensive effort to smooth the path, addressing both the fiduciary side and the market regulation side. The order directs the SEC to facilitate the use of these alternative assets in 401ks and other retirement accounts. So the SEC, which oversees markets and investor protection, will likely be looking at things like, how do we ensure adequate disclosures? How do we prevent fraud? How do we maintain market integrity when these new, maybe less understood assets enter mainstream retirement plans?
So a coordinated government push.
Yeah, it indicates strong political will. They want this to be a reality, not just a theory.
Now, the markets, they don't wait, do they? Our sources say even before the official signing, just a leak of this news sent, well, immediate and pretty dramatic ripples, especially through the crypto space. What happened?
Oh, yeah, the reaction was swift and very pronounced, especially in crypto. It really signaled this belief, maybe hope, within the crypto community that, institutional validation was finally arriving.
So what were the numbers?
Bitcoin, the big one, jumped more than 2%. It was trading near $116,000. Ether, the Ethereum coin, saw an even bigger jump, almost 5% back to a one-week high. And XRP was up over 4% too. It wasn't just like a small blip. It felt significant, signaling belief that serious capital might start flowing in.
And it wasn't just the coins themselves reacting, right? What about the companies involved in crypto, the stocks?
You're right, good point. We saw a significant boost in crypto-related stocks too. Shows how interconnected it all is. Coinbase, the biggest public crypto exchange, its shares surged as much as 3%.
Okay.
Other platforms like Robinhood ticker 8head, which offers crypto trading, and MicroStrategy MSTR, the company famous for holding tons of Bitcoin.
Right, Michael Saylor's company.
That's the one. Their shares each rose over 1.5%, even saw a nearly 8% gain for Bitmine immersion, which is tied to Ether. It reflects this excitement about the whole ecosystem, the infrastructure, the access points.
Broad excitement there. What about the other alternative assets? Any reaction in private equity stocks?
A bit more muted, but yeah. Apollo Group, a major private equity firm, their shares were slightly higher in early trading. So while crypto got the biggest immediate pop, the news resonated across the alternative investment world too. They're all anticipating potentially huge new inflows of capital from this 401k market.
So for the alternative asset industry itself, the folks managing private equity, real estate, and now potentially crypto funds, this is being called a major victory.
Absolutely.
Our sources say they've been actively pushing for this, getting these assets into defined contribution plans, especially during Trump's second term. Seems like their lobbying paid off.
Indeed. And this order really marks a major shift, as the sources put it, in retirement investments. For ages, the retirement industry has been seen as, well, traditionally Stayed. Very conservative, predictable, focused on established, highly liquid stuff like stocks and bonds. And that wasn't by accident, right? It was driven by regulations meant to protect savers from big risks and situations where they couldn't easily get their money out.
Makes sense.
So when we talk about this order pushing towards potentially more speculative and sometimes illiquid investments, it's not just swapping assets. It's fundamentally changing the risk-reward calculation for retirement saving. It's moving away from that purely public, highly regulated world, it's a basic rethinking of how America's long-term savings are managed, offering new ways to grow, potentially, but also introducing different kinds of risks people might not be used to in their 401k.
That's a really powerful statement, suggesting this fundamental shift. But to really get the scale of this blowing open of doors, we need to understand the why. Why were these assets kept out for so long? And what's changed so much now in the financial world or the regulatory thinking to bring us here? Why not 5 or 10 years ago?
Yeah, connecting it to the bigger picture is vital. Why the exclusion in the first place, and how has that view started to shift? Historically, the main worry for 401ks, especially under ERISA, was always investor protection and liquidity.
Right. Keep it simple, keep it safe.
Exactly. The guiding principle was a straightforward, transparent, easily sellable investment environment for the average person. Most plans offered, simple stock funds, bond funds, maybe index products, things known for transparency, daily pricing, easy liquidation. You can generally sell them quickly at a known price.
And private market assets, which would eventually include crypto, I guess,
Yeah.
just didn't fit that simple, safe mold.
Precisely. Private market assets were kept out because of real concerns that went against those core ideas. First, high fees. Compared to public funds with tiny expense ratios sometimes, private investments often have higher management fees, performance fees, things like carried interest. Those fees can really add up and eat into your returns over decades of saving.
Especially with compounding, yeah.
Definitely. Second, a lack of transparency. Public companies have strict reporting rules. Private companies, much less so. Makes it really hard for an individual or even a plan sponsor to do proper due diligence.
Okay, fees, transparency, what else?
And critically, the longer lockup periods. Think about private equity. Your money might be tied up for like 7 to 10 years, maybe longer, before you see anything back. Highly illiquid.
Can't just cash out if you need it.
Not easily, no. Real estate funds can also have limits on when you can withdraw. It's totally different from a mutual fund you can sell any day. So all these things combined, high fees, opacity, illiquidity, made them seem like riskier investments compared to the standard public options in 401ks. The goal was always to shield regular savers from complexities and potential losses they couldn't easily navigate or afford.
So big institutions, endowments, they could handle this stuff, but not the average 401k participant.
That was the thinking, yeah. They have the scale, the long timelines, the expert teams. The retail 401k market is just different.
Okay, so that was the historical view, safety first. But this executive order didn't just materialize out of thin air, did it? It feels like the ground has been softening for a while.
That's a crucial point. The groundwork for this was laid years ago. It shows an evolving regulatory view. Even before this new order, back in 2020, the Department of Labor under the first Trump administration issued an important information letter.
An information letter?
Yeah, basically guidance. And it stated that private market exposure in defined contribution plans could be appropriate under certain conditions. That was a big deal, a crack in the wall. It signaled these assets weren't forbidden, just required, careful thought and strong due diligence by the fiduciaries.
Interesting. And that view continued.
It did. What's more, that guidance was later affirmed by the Biden-directed agency. So you see some bipartisan continuity there, on this specific point at least. It suggests a growing consensus that maybe, under the right controls, these assets could be integrated.
So even without this big executive order, there was already a sense that these assets might have a place.
Yeah.
And our sources say this subtle shift has already led to them appearing more in the retirement space.
Precisely. The asset managers, the plan sponsors, they weren't just sitting on their hands. They've already started creating products designed to offer some exposure to alternatives within retirement accounts, carefully, within the existing rules.
So the industry was already moving in this direction.
Yeah, this proactive work by the industry is a key reason the executive order isn't a total shock. They've been building the pipes, testing the waters, showing it could be done. And to really grasp the scale here, think about the money involved. Americans hold roughly $8.7 trillion in 401ks alone, end of Q1 2025.
8.7 trillion. Just in 401k.
Yeah, and the total U.S. retirement market, all pensions, IRAs, everything, is a staggering $43 trillion.
$43 trillion.
It's immense. So even a small percentage shifting towards alternatives means a massive injection of cash into that market segment. We're talking potentially hundreds of billions, maybe trillions over time.
Okay, with numbers like that, it makes total sense why the big financial players would be very interested. And it's not just talk. Sources show some huge names are already making real moves even before this order dropped.
Absolutely. Take BlackRock, world's largest asset manager.
Everyone knows BlackRock.
Right. In June, they announced something pretty significant. They're launching a 401k target date fund in the first half of 2026. And the key part, it will include a 5% to 20% allocation to private investments.
In a target date fund, those are super common.
Incredibly common, especially for people who want a set it and forget it approach. They automatically shift your investments to be more conservative as you get closer to retirement.
Okay.
The fact that BlackRock, a giant, is embedding private investments into such a core, widely used product like that, it signals a deep long-term belief. It moves these assets from being some niche add-on to potentially a core part of a diversified retirement strategy for millions.
And Larry Fink, BlackRock's chairman, he's been pretty outspoken about this, hasn't he?
Yeah.
It sounds like more than just a business move for them.
Yes, Larry Fink has been very clear in his annual investor letters. He's making a strong case for this evolution. He said, private assets like real estate and infrastructure can lift returns and protect investors during market downturns. That's a key argument. Diversification, resilience, maybe earning a premium for the illiquidity, or hedging inflation.
So benefits beyond just chasing higher returns.
That's the pitch. And he also directly addressed the regulatory side, saying, we need to make it clear private assets are legal in retirement accounts, they're beneficial, and they're becoming increasingly transparent. He's actively trying to dispel doubts, encourage adoption, and point out that maybe these assets aren't as opaque as they used to be, thanks to better data.
Sounds like a real push to normalize these things. Is BlackRock alone here, or are other big providers getting in on this?
Not at all. Empower, they're the country's second-largest retirement plan provider, also announced back in May that they intend to join asset managers like Apollo in allowing private assets in some accounts later this year.
Empower, too. That's huge. They manage plans for millions of people.
Exactly. Their entry really legitimizes the trend. It provides a direct path for employers who use Empower to actually offer these options to their employees. It moves it from theory to practice for a lot of people. This kind of scale from these massive players, it suggests a tipping point was maybe already being reached, even without the EO, but the order definitely accelerates it.
Okay, and what about crypto specifically? Our sources mentioned Fidelity and other huge name in retirement. They've already dabbled with Bitcoin and 401k. What's the story there?
That's correct. Fidelity took a pretty big first step. They created options to allow Bitcoin allocation within their 401k platform. That was pioneering stuff, offering direct crypto exposure in a retirement wrapper.
But how's it going?
Well, the sources note that adoption by employers, the companies offering the 401k plans, has actually been pretty low so far.
Oh, okay, so Fidelity offers it, but the bosses aren't signing up.
Seems to be the case, largely. It highlights a key hurdle. Even if the provider makes it available, the employer has to agree to offer it in their specific plan. And maybe many employers are still hesitant, worried about the volatility, the complexity, maybe potential lawsuits if things go wrong, or just plain unfamiliarity.
Right.
So this executive order, with its directives to the DOL and SEC, might give those employers the regulatory clarity or, frankly, the cover they need to feel more comfortable offering these options. It shifts the burden, maybe, from the employer having to figure it all out themselves.
Okay, so it really sounds like this isn't out of the blue. There's been this clear buildup, big players testing the waters, providing options. But now, with this executive order explicitly naming cryptocurrencies, what does this mean for crypto specifically? Is this really it? The moment the crypto world has been buzzing about the holy grail of adoption.
You know, for the crypto world, holy grail isn't really an exaggeration of how this is being seen. And for good reason. It's considered a holy grail because it promises mainstream integration on a scale that was, frankly, hard to imagine before.
Transforming it from niche to normal.
Potentially, yeah. Widespread inclusion of Bitcoin, maybe other digital assets. In everyday Americans' retirement accounts would effectively make them a mainstay of U.S. financial infrastructure. It's not just about letting individuals buy it, it's about institutionalizing crypto, embedding it into the very fabric of how a massive part of the population saves and invests long-term.
Yeah, that's a huge perception shift from something fringe on specialized exchanges to something sitting alongside your mutual funds in your 401k.
Exactly. Officially recognized, facilitated, maybe even implicitly endorsed within the traditional system.
And what about just the ease of access? For someone who maybe felt crypto was too complicated, setting up wallets, using exchanges. Does this make it simpler?
Absolutely. That's a huge part of it. It significantly broadens the pathways for regular Americans to get involved. Instead of needing to learn about exchanges, private keys, self-custody, which, let's face it, can be intimidating. The idea is you could potentially just allocate a slice of your retirement savings to Bitcoin or whatever is approved directly through your existing 401k provider, your Fidelity account, your Empower portal.
Using the website they already know.
Exactly. It dramatically lowers the barrier to entry, leverages the trust and familiarity people already have with those platforms.
And maybe changes the mindset too. Crypto is often seen as this super volatile short-term trading thing. Does putting it in a retirement account change that?
That's another really interesting potential effect. For an asset class so often linked with, when moon and speculation and quick trades, putting it in a retirement plan could profoundly encourage a longer-term view.
Because retirement is long-term by definition.
Right. Decades, usually. So this shift could inherently foster a more patient, strategic approach to crypto investing among the masses. Maybe that could even have a stabilizing effect on the crypto market itself over time. Reducing some of the speculative churn, increasing the base of long-term holders. Imagine millions of people dollar-cost averaging into crypto every paycheck for 20 or 30 years via their 401k.
That is a different picture entirely. Now, we've heard from industry leaders. One name that always pops up in crypto is Michael Novogratz, CEO of Galaxy. What's his take on this? Does he see it as this holy grail moment?
He does. Novogratz, who's obviously a huge figure in the space, really emphasizes the sheer potential being unlocked here. He talks about that monster pool of capital in the retirement market, that $43 trillion number.
A monster pool. Yeah.
For him, it's not just allowing crypto, it's about this fundamental shift in accessibility, a gradual widening of the doorway into digital assets. He put it quite nicely, saying, we're seeing the aperture of being able to buy crypto being widened, and more avenues bringing people into the tent.
Bringing people into the tent. I like that.
Yeah. He envisions a future where the friction, the difficulty of investing in crypto is just dramatically reduced, making it as easy as buying a stock or a bond fund.
And his main point seems to be about making it convenient.
Right.
Using the systems people already trust.
Precisely. His core argument is about normalizing access through familiarity. He explains, when it becomes commonplace, when you can do it at the place you've already been doing business with, if it's Fidelity or T. Rowe Price or whoever it is, you just pull more people into this ecosystem.
Makes sense. People stick with what they know.
Yeah, it underscores the power of that existing infrastructure. People are comfortable with their 401k provider. They trust the platform. They know how to use the website or app. If crypto just becomes another option there, it leverages all that existing trust and makes the leap into digital assets seem much less scary for the average person. It's integration, not just permission. Removes those psychological barriers.
Now, this order doesn't exist in a vacuum, does it? It seems to fit into a bigger political picture, part of this stated goal to make the U.S. the crypto capital of the world. How does this EO fit into that strategy?
That's an excellent point. It's explicitly framed that way, the latest in a series of efforts under the Trump administration towards that very ambitious goal. It seems part of a coordinated push. The administration appears to view fostering a strong crypto industry as not just an economic plus, but maybe a strategic necessity for tech leadership and financial innovation.
So more than just finance.
Potentially, yeah. And it builds directly on momentum we saw recently, like during what was called Crypto Week in Washington back in July 2025.
Right, Crypto Week. What happened then?
Well, during that week, both the House and Senate were actively working on key crypto legislation. It showed a real focus, maybe even some bipartisan or at least bicameral agreement, on needing to define and integrate digital assets legally and financially. It suggests this isn't just one branch acting alone.
Can you give us some examples? What specific laws came out of Crypto Week or moved forward?
Absolutely. One huge one was the Genius Act, GENIUS Act. President Trump actually signed that into law on July 18th, 2025.
The Genius Act.
Okay. It's a landmark because it sets up a clear regulatory framework specifically for stablecoins like Tether or USDC. Those are the cryptos pegged to the dollar.
Why are stablecoins so important to regulate first?
Because they're seen as a crucial bridge between traditional finance and the crypto world. They offer stability in a volatile market. So having clear rules around them, ensuring they're backed properly, managed safely, builds trust, and allows them to be used more widely, maybe for payments, not just trading. Our sources call it the first official U.S. crypto law, which is a big milestone.
Okay, so stablecoin regulation is done. What else was moving during Crypto Week?
Yes, two other important bills made progress showing this broader legislative effort. First, the Clarity Act. This one tries to tackle a really thorny issue: who regulates which crypto?
Ah, the SEC versus CFTC question. Security or commodity?
Exactly. That uncertainty has been a major headache for the industry. The Clarity Act aims to define those regulatory lanes more clearly, hopefully providing a stable rule book so companies know who they answer to while still protecting investors. It passed the House, now waiting on the Senate.
Okay, that's potentially huge for the industry. And the second bill?
The second one is the Anti-CBDC Surveillance State Act. This one is interesting. It aims to block the Federal Reserve from creating a U.S. central bank digital currency, or CBDC.
Blocking a digital dollar. Why?
Well, supporters of the bill raise concerns about potential government overreach. They worry a CBDC could allow too much government tracking of private financial transactions, since every digital dollar could theoretically be monitored.
Privacy concerns.
Big time. And maybe fears about programmable money dollars that expire or can only be spent on certain things. While others argue a CBDC could improve payments and inclusion, this bill reflects a strong pushback on those grounds. It also passed the House, waiting on the Senate. Shows a clear debate happening about the future of money itself, government-controlled digital currency versus decentralized options.
Wow. Okay, so you have this executive order opening 401k. You have Congress passing stablecoin laws, debating who regulates crypto, pushing back on a digital dollar. It really feels like a coordinated effort.
It does. This convergence, the policy push from the White House, the legislative action in Congress, and the clear readiness and moves from big industry players like BlackRock and Fidelity, it's really paving the way for potentially unprecedented access to these alternative assets, especially crypto, right inside retirement accounts.
So how might this huge shift, this convergence of political will and financial plumbing, fundamentally change things? Not just the perception, but the actual integration of digital assets into mainstream finance. And maybe more importantly, what does it mean for you, the individual investor, trying to figure out this new landscape, both the opportunities and maybe the new responsibilities?
That's the multi-trillion-dollar question, isn't it?
So let's try to sum this up for everyone listening. What does this all mean for you? We've explored how President Trump's executive order is swinging the doors open on the massive $8.7 trillion 401k market, making way for alternative assets like crypto, private equity, and real estate.
Right. We saw that immediate positive market reaction, especially in crypto, Bitcoin, Ether, related stocks all jumping. It shows the market believes this expanded access is coming, and it's significant.
And we looked back, understanding why these assets were kept out. Those concerns about fees, transparency, liquidity, but also how that stance started shifting even before this order with that 2020 DOL guidance.
And we highlighted the big moves already happening. Financial giants like BlackRock integrating private assets into core products like target date funds, Empower opening up access to, even Fidelity's earlier steps with Bitcoin, though employer uptake was slow, showed the direction things were heading.
We also touched on that bigger strategic picture, positioning the U.S. as a crypto leader, backed by laws like the Genius Act for stablecoins and the ongoing debates around the Clarity and Anti-CBDC Acts. It really marks a huge shift from the traditionally staid or conservative retirement world, potentially making things like Bitcoin commonplace in your retirement portfolio, moving them from maybe a side bet to a core holding.
Yeah, commonplace. It's a possibility. This deep dive really shows a financial world that's, well, in flux. It's offering new paths for retirement growth, maybe significant growth, but it also fundamentally changes the conversation around risk. It highlights how important it is to understand the complexities of these newer, often more volatile, sometimes less liquid assets.
Definitely. Which brings us to our final thought for you to mull over.
Yeah, given those traditional concerns we talked about, the higher fees, the lack of transparency historically, the longer lockups for things like private equity, and considering the wild volatility crypto is famous for, how might this potentially massive influx of retirement money, your money perhaps, change these assets themselves? Could it impact their long-term stability? Could it force more regulation? Could it even change the fundamental nature of crypto for the everyday American investor?
And what new burdens or maybe opportunities does this place on financial advisors? They'll need to guide a much wider range of people through these new complex choices.
And maybe most importantly, what new responsibilities does this place squarely on you? If you're managing your own retirement savings, you now have potentially more options, but also more complexity. How do you understand these evolving choices, assess the real risks involved, and make informed decisions about your own financial future in a landscape that is, well, clearly being rapidly redefined right before our eyes?